We have an incredible opportunity to buy this growth company with a forward P sitting below 11, and right now it is down around 20% from its 52-week high. Before we even talk about the match group, we want to let you know that the activist company Starboard have now taken a stake in this company, and this was around July. Now, you may have heard of Starboard from their position they have took in Starbucks not too long ago. Now, we're just going to highlight a few things. First one, as we will come to show you, if you are new to the Match Group, they have many portfolios within their brands, all in the dating arena. There's Tinder, Match, The League, and a few others. Now, Starboard's average cost in this company is around $33, and that is a little bit higher than what it sits at today, so you could be considering this company at a lower average cost than the activist. And one thing to note with Starboard, they are very successful. What they tend to do is turn around companies, help look at their operational efficiencies, increasing their margins, which is something we always like to discuss on this channel, and their average return sits around 25.5% versus the 13.61 from the Russell 2000 over the same period from when they started in their history. In fact, 46 of these situations, they have performed very strongly. As we mentioned, they want to turn around companies, looking at the operational efficiencies that they can implement, and very impressive track record, 44% versus 16. Now, the reason why we're talking about this today is due to the fact that they have added to this position. In fact, when we take a look not too long ago in the more recent quarter, they've added more shares, and therefore their position now sits around 7.7% of their total investment portfolio, making it the 5th largest holding that they do currently have. Now, just as a reminder for those that are maybe new to this company, we can see a lot of brands. Maybe you will recognize them from their icons, but this is a large company that does sit in the dating arena. And when we actually look at the numbers, once again, it is currently trading towards the lower end of the 52-week range. We have a double buy rating, that is from Quant and Wall Street. We get a hold from Seeking Alpha. As we already established, forward P is fairly low at 10.7. We will compare this to the sector. Over the last year, not the greatest performance. They have been flat. We'll discuss on some of their metrics. And over the last 5 years, we can see they are down around 52%. Now, if we take a look at their earnings moving forwards, over the next 4 quarters, they do anticipate 3 of them to be double-digit growth. However, the upcoming Q4, they are anticipating a negative 21% year-on-year decline. And when we look back over the last 4 quarters, at least 3 of them have been at a bare minimum in line. 1 was a miss, giving them a 75% track record. Now, if you believe them in terms of their historical forecasting accuracy, over the next full year, the EPS is anticipated at 345, which in turn will lower the forward P even more to 9.54. Now, let's just take a look at their earnings from their more recent quarter, digest some of their information, and the first thing to note is that their top line revenue is up around 2% on a comparison with the same quarter last year. You know, on this channel, at a bare minimum, we want to see 3 to 4% just to keep up in line with inflation. The number of people who are paying on their apps is down around 3%. The RPP, now that is the revenue per paying customer, that is up 5%. That is good to see from the same quarter last year. Their operating income did sit around 211 million, and whilst that is down from the same quarter last year, when you do remove one-off items, we can in fact see here from the graph the adjusted operating income is up marginally by around 3%. One thing that's very nice to note, given the fact they don't currently pay a dividend, although they actually had done in their history of the company, is that they are doing share repurchases. They spent around $241 million, and remember, that is a way of returning excess cash to investor pockets, giving you a larger portion of control of the company. And when we look at the metrics on a graphical format, we can see here overall their revenues are up, their operating incomes are up on an adjusted basis, their operating cash flows are up as well as their free cash flows. One thing that we do notice is down are those paying customers. However, we can see that the revenue per customer has gone up by around 5%. In terms of looking at the numbers specifically, well, total revenue, as we can see, is up around 2%. In terms of their largest driver to this growth, it has been the Hinge app, which is up 36%, and we do note the more popular ones like Tinder down 1%, as well as their Match group in Asia. As we also mentioned, total payers are down, however the revenue per paying client is up around 5%. Now, this company did face a drop after they reported their more recent earnings last month, and the main reason for that is that they released their Q4 guidance, where they said that their revenue is anticipated to be essentially flat versus the same quarter in 2023, and also their adjusted operating income will be down around 5% from the same quarter. So the market didn't like their guidance, but one thing we can do is take a look at the metrics of this company, and we also want to let you know when we do get to our valuation today for this company, when we have put in zero growth moving forwards, there is still a lot of upside and a nice margin of safety. So let's just take a look at the free cash flow per share. We do notice it is inconsistent over the longer term. One thing we want to see on this channel is essentially growth consistently over the longer term. And also, just to let you know, we don't typically look at the earnings due to the fact it is susceptible to manipulation by management through accounting. Now, free cash flow, it is inconsistent. It has increased over the longer term. One thing that is nice to see is over the next 12 months, they are anticipating around 10% uplift to that free cash flow to $3.33. In terms of the sales growth, at a bare minimum, 3 to 4% just to keep up in line with inflation. In fact, from 2019, it has looked very strong. Even the 6 to 7% is still very reasonable over the last few years. And from a numerical perspective, we do get a large drop from 2017 to 2018. Nice to see though, from that period, it has started to increase and move in the right direction, something that we do hope continues. And in fact, on a trailing 12 month, we do anticipate 2024 overall, even with the guidance for Q4 that does look to be flat, the 2024 year as a whole looks to be fairly strong. In terms of shares outstanding, now we don't like it when companies issue shares and dilute our position as a shareholder. Unfortunately, something this company has done from 2014 to 2023, but as we saw in the more recent quarter, they have done share repurchases, and that is something we have noted from 2021. Hopefully, if they do continue that, that will be very nice to see. And one thing it could indicate is that management right now believe that the company is undervalued and therefore want to aggressively buy back as many shares as possible, something definitely we will keep our eye on. ROIC, we want 10% or more. Give us faith, management are able to effectively allocate their capital. Looking very strong over the last 4 years in the 20%, 22 as well on a trailing 12 month. Good sign, investors will love to see that. Then on the operating margin, we want to see two things. One, above 16% at the bare minimum. Second, we want to see operating efficiency, margins increasing. Now, from 2018, it has started to decrease. That is what we would say is operating deficiencies, but we do note it is above the 16%. And as we saw, starboard investors, typically they come in, they do look for ways to increase the operating efficiency, and therefore we could anticipate one of the things they will look to do is help increase its margin over the longer term, something we do quite like to see as investors. And free cash flow margin, the bare minimum we want to see here is 5%, looking very good. Even though it is very inconsistent, still even 20% on a trailing 12 month is a lot stronger than the majority of companies that we do review on this channel. And then we get to the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. We want to see below 3. Now remember, this correlates to balance sheet strength. The numbers that you see here reflect the number of years it would take Match Group to pay off all of their debt net of cash on hand. Now we want to see below 3. 2023 it is below that. Nice to see they have been delivering the balance sheet, paying off a lot of debt over the last few years, and nice to see anticipated over the next 12 months to come down to around 230. Hopefully this is something we can see move in that direction over the longer term. Now we also want to let you know we have released our latest free weekly article where we cover 2 cheap stocks that have gone under the radar. Now we release one every single Monday morning to your inbox, and we do talk about companies that are severely undervalued that deserve your attention, as well as what's gone on in the market over the last few days. So click below, you can sign up and start reading. You'll also be able to gain access to 28 undervalued dividend stocks for the month of December. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab another spreadsheet recently released of 29 dividend stocks with massive upside. In fact, these are stocks that Wall Street themselves believe have the most upside right now out of the whole S&P. So click below, sign up, and you can start reading straight away. We also like to highlight insider ownership, which sits at 0.77%. Now we have around 63,000 worth of insider selling over the last year. Very trivial. We can see the most recent was around 25,000. Now we will show you for transparency, and we can see it was a director just a couple of weeks ago who sold around 801 shares, netting him just over $25,000. Now we do show you insider selling, even though we don't believe it to be a bearish signal. Management sell for many reasons, both personal and financial. Then we get to institutional ownership. That is very high, one of the highest we have seen on the channel. Now we notice around 1.2 billion worth of sales by the institutions over the last year. We see more buying, around 1.66 billion, and we also notice that trend in the more recent quarter as well as all of 2024. So institutions, clearly they are bullish on Match Group as well as Starboard Investor, but as always, do your own due diligence, never copy institutions, never copy insiders, always have your own investment thesis, and as we said, very important, always do your own due diligence. Now we did take a look at the revenue, we will highlight that, but we want to essentially pinpoint their bottom line. As we saw, their revenue from 2018 has been steadily increasing over the period, and we also notice based on the trailing 12 month that upwards trajectory is anticipated to continue. Then we move on to their bottom line. That is really what we want to flag here. And just from a graphical perspective, we do notice a lot of inconsistency, but similar to their top line from 2020, it has started to increase, moving in the right direction, and hopefully we can see this continue, as ideally top line revenue should correlate to their bottom line net income. And as we've already mentioned, with Starboard coming in, hoping to improve their efficiencies, that should really start to show on their bottom line over the next few years. In terms of the balance sheet, we've already highlighted their net debt to EBITDA, but let's have a very quick look at the health of the company. Cash versus total debt, which we do notice has been decreasing over the longer term. Cash was around 1.1 billion in 2014. Right now it sits at 861 million, so it has decreased, although fairly marginally. And remember, one number in the balance sheet will not tell us anything, which is why we compare it numerically and directionally to their total debt. Now that in itself has been increasing consistently over the longer term, around 1.1 billion in 2014, now sitting around 4 billion. Now we did see their net debt to EBITDA, it is below 3, it has started to decrease, so for now it does look to be safe, it does look to be secure, but as always something we can keep our eye on when considering this company. And then we want to move into some gradings. The first one is the valuation, where they get a B. Now, in terms of comparing it to the sector median, Match Group at 10.7 on a P non-GAAP forward-looking basis is lower than the sector median of 13.59, meaning right now it is trading at a discount, and if you are buying it, essentially it is around 21% lower than the sector. On top of that, when we look at the 5-year average P for this company, it does sit around 33, so right now it is trading around 68% lower, and the majority of the valuation metrics today do show that, although we do have one or two that does show it is a little bit more pricey than the sector median. In terms of the growth grade, they get a B+. Revenue year on year, 6% better than the sector median at 1.4. Moving forwards, around 4.4%, sector median around 2.3. And one of the main things that we do like to draw your attention to is that earnings per share over the next 3 to 5 years anticipated to grow at 23%, much better than the sector median at 10.6, which is why we do get that very positive growth grade. In terms of profitability, well, B+, as we can see, 73% on the gross margin, a lot better than the sector median at 52%. Their bottom line also very strong, very healthy at around 18%, a lot better than the sector median at 3.6%. And when we look at their cash from operations, again, significantly better, 954 million versus the sector median of 288. Now, as a quick conclusion for this part of the analysis, we get a double buy rating from Wall Street and Quant, a hold from Seeking Alpha, B on valuation, B+ on growth with a B+ on profitability. Now, two more things before we jump into the valuation. First one, comparing them against others in this interactive media service industry. Lots of large names, I'm sure you've heard of many of them. And in terms of the return over the last year, as we already pinpointed, this company pretty much flat, not great, but not far off some of the others, although there are one or two that have performed fairly well. And when we zoom out to over the last 5 years, we can see down around 52%. Do remember though, past performance is not an indicator of the future. They could perform significantly better, but at the same time, they could also perform much worse. In terms of comparing it to the S&P, although the answer should be obvious, right now, pretty much flat. S&P up around 33%. Over the last 5 years, we can see, whilst this company is down 52%, the S&P nearing the 100% mark. Reason why we compare it always against the S&P, just in case you don't have confidence in individual stocks and you do want to take a look at a low-cost ETF. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, intrinsic value, $39, has been derived from the DCF model. Now, we're going to jump into it just to show you how we got to the figure. But as you can see here, the free cash flow year on year, the average growth over the last 10 years has been 16% on a year-on-year basis. Now, we've gone for 0% moving forwards. We've gone for the lower end to be very, very conservative just to show you the potential opportunity. And with the discount rate at 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see today, $39. And this would indicate 19% upside. Now remember, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Match Group or any others. But full transparency, we'll show you at the 2% level, that would be an intrinsic value of $47, 43% upside. At the 4% level, $56 and 71% upside, all of which you could justify. Even 4% you could believe is quite conservative when you do look at the average growth over the last 10 years at 16%. Nonetheless, we want to be very conservative today at 0%, and when we do get to our intrinsic value, we always like to add a margin of safety, and at 10% we execute on companies if they have our 3 golden criteria matched off. That is a wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode we'll buy at around $35, then we keep going till it's near the current trading price, and what we can see, it isn't at the 20% level yet, so it's sitting around 15 to 20%, 15% up to $33. Wall Street, on the other hand, their price target of $40, not far off our intrinsic value. They see upside over the next year of 22%. Now remember, our valuation here is based on a very conservative 0%, meaning that they wouldn't grow their free cash flows over the longer term, and that gives you 15 to 20%, whilst Wall Street at the 20% level, making this definitely a company to consider, especially if you believe in the longevity of online dating. As always, give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter. Go grab those spreadsheets and come and join us in the Patreon where we do cover our weekly buys and sells. As always, have a great day and we'll see you all on the next one.